Good afternoon and welcome to this week's Market Matters video update. It's the second day of February today, Wednesday, here in the office, Jimmy. We're going to talk about performance to start the week, the first month of 2022. James, what did you make of the market all up to get things underway?
It was a pretty torrid market, pretty torrid start of calendar year 2022. The ASX 200 was down 6.35%. The US market was down something similar as well. So the S&P was down a bit over 5%. If I look at small caps, so the ASX Small Ordinaries Index was down over 9% for the period. So that was obviously provided a pretty interesting backdrop for your portfolio. In terms of our sort of view around the market, we wrote a lot about in our 22 Outlook report, just around the year being more volatile. We were a little bit more bearish on equities leading into it. The swiftness and the speed of the decline caught us. There's no two ways about it. We remain fully invested throughout that period. But fortunately, I'm going to detail today we'll go through the portfolio performance during that period. I think it's really important from a subscriber perspective to understand how different portfolios perform in different sorts of markets. I've always been of the view that looking at portfolio returns in weaker periods is what you really should be doing. And that to me is a really important measure or metric to look at. So we'll detail our performance today, Harry. But overall, I mean, the market pulled back pretty swiftly. The ASX was down from high to low over 11%. So it was a pretty decent decline. If I look forward, when we have a January that's down that much, we generally have a pretty strong bounce back, and I think that bounce back is underway. I'm not getting bearish here. I think the market probably recovers, and there's a good chance, as we wrote this morning, that the market goes and trades to a new high. But I think it's going to be a huge amount of sector rotation. We're going to have high levels of volatility this year, and it's going to suit our approach, hopefully. So hopefully we make some good decisions and we continue on the period of outperformance that we generally achieved in January.
Yeah, the worst January since 2008, James. You remember that one well.
I do, yep, absolutely.
Kicking things off with the Flagship growth portfolio, it's our main portfolio, as the name would suggest. How did that one go in the weak market?
It was down 4.07% for the month. So, obviously not ideal. We'd like to be making money in that portfolio, but against the backdrop with the market down 6.3 odd percent, and we were fully invested during that time. And I think one of the things we did at the end of January was also rejig the portfolio to take advantage of the market bounce, and I think at the start of February it started pretty well. So a weak month for the market, but I was reasonably comfortable with how the portfolio performed into that weakness. And I look through the portfolio and there's some great positions in there. I'm really upbeat around what the portfolio can deliver here, with the mindset that we're going to retain that active approach throughout the year, and I think that's going to be key in 2022.
Yeah, definitely. Another portfolio that outperformed the market but was also a little bit low is the income portfolio, James. Sort of did what it should in a market like that, do you think?
Yeah, it did, absolutely. So we frame this portfolio as something that obviously provides regular income, but it also does that with having lower volatility than the underlying equity market. The equity market down more than 6%, the income portfolio down a shade over 2%. Bear in mind that we're 70% allocated into Aussie equities, and we're about 30% split between fixed income type securities, hybrids, and cash. So you think of that backdrop, we had very low downside capture. We captured about a third of the market decline. But on this bounce back since the low, we've captured more than that on the upside. So really happy with that portfolio performance. Lower downside capture, higher upside capture is really the key. And consistency and lower volatility is sort of the driving metrics behind that portfolio, Harry.
Good stuff. The two standout portfolios in our suite of 5 were those with more international allocation. Good reason for that being the Aussie dollar having a difficult time in January. The ETF portfolio and the international portfolio both were higher for January, James. Run us through how that happened.
So the international equities portfolio, the Aussie dollar, you're right, the Aussie dollar did help. So the Aussie dollar was down 2.74% in the month. So that obviously adds to portfolio performance. The portfolio was up in aggregate terms, 1.54%. So if you think about, if you strip out the Aussie and assume it was a hedge portfolio, it's still only down pretty marginally over the period. So it wasn't all doom and gloom in the international equities portfolio. A positive performance in a really weak month speaks to the and I've said this a lot of times, and I speak to clients about it who, that we manage their portfolios here at Shaw, is around having diversification across asset classes, and having international equities in a portfolio provides a cushion when markets are volatile like they were, because the Aussie dollar is a risk currency and it traditionally sells off in volatile times. So I was happy with the international equities portfolio. It hasn't been, we've tweaked that at the back end of the month. We sold out of BHP in London before that went off the boards there, and we increased our tech holding. You might be saying, well, you're bearish on tech going into 2022. That's true, but they were very oversold. Stay with high quality tech, and we'll be active around our technology exposures this year. And of course, the ETF portfolio, it was up just shy of 1%. It was up 0.84 of 1% for the month. Again, it was a reasonably defensive portfolio. 10 of our top macro calls sort of played out in January, so comfortable with that portfolio performance as well, Harry.
Yeah, definitely. You started off the video talking about underperformance of small caps this year. It certainly didn't help the emerging companies portfolio in January, did it, James?
Yep. Absolutely not the best till last in this case. So as I said, the small ordinaries was down 9%. This portfolio dropped 10, so worse than the market. So that's not an ideal outcome for that portfolio. We did a portfolio review at the end of the month, and we made some reasonably large changes to the portfolio. We trimmed a couple of the stocks that had held up reasonably well, that we thought were, on a relative sense, didn't offer as much value as some of the stocks that had pulled back that we held. So we trimmed 2 holdings, or cut 2 holdings, one for a profit, one for a loss, and then reallocated those funds into some of the oversold positions in the portfolio. We like what we're holding. It's bounced strongly at the start of February, as have a lot of the small caps out there. So I'm not concerned about the portfolio. I would have liked to have performed better in January than we did. But yeah, looking forward, I'm comfortable in that portfolio as well, Harry. So onwards and upwards there.
Definitely big volatility to start the year. 11 months ahead of this one, so let's enjoy the market for the rest of 22. Hey,
exactly right. We thought it was going to be a volatile year, probably a little bit sooner than we anticipated. But I think you've got to, that we keep writing about it, having an active approach in the market is going to be key this year. And obviously that's what we'll write about, follow and track in Market Matters. So keep across the reports, log into the website to see what the portfolios are doing. And we look forward to bringing you these weekly updates throughout the year, Harry.